Good afternoon, everyone, and welcome to our exclusive client Unio event here today. I am Áine McGroarty, Chief Commercial Officer at Unio, and I'll be your host today. And I'm joined by Mike O'Sullivan, our Chief Investment Officer and Director at Unio, and our in-house expert on all things geopolitical and financial markets. So thank you firstly, Mike, for
Thank you,
joining us,
Áine.
and thank you everyone for taking some time out. We understand everyone's time is precious, and hopefully it's time well spent for you here today. And we felt the call to action to have this session because clearly there's been a lot of recent developments with the US. We're here to address that Trump tariff effect, which is sending absolute ripples through the global economies and the global markets. And so hopefully our goal today is to help you make sense of what's actually happening out there and a bit of the why, explore that broader economic and market impact, gauge those reactions in Europe and across the world, and really talk to our outlook within Unio and our investment committee. So we have 20 minutes in the diary. Will we dive right in, Mike?
Let's go on. Yeah, plenty to chat about. Yeah.
Exactly. So I think maybe if we start with a brief recap, I know we're all reading the headlines over the last week and seeing the reactions, but could you maybe start with telling us what in the world has just happened and why?
In a way, Áine, we shouldn't be surprised given the diplomatic offensive that Trump and his team launched in February and March on Europe and effectively threatening to pull out of NATO and to leave Ukraine at the hands of Russia. I think what has surprised a lot of people, and maybe more rational economists, is the apparent damage that Donald Trump and his close advisors like Peter Navarro are prepared to do to America's reputation, its economy, its financial system, in order to reorder the trade balance. America is effectively a services, not a manufacturing-driven economy, and it benefits by the fact that other countries can produce goods cheaply, and American companies, the big multinationals we know very well, have benefited from that. So I think the stance is strange. It's very aggressive. It's a departure from the first Trump presidency. And I think also what is maybe missing here is a roadmap and a sense as well as to how Donald Trump and his colleagues want to entice investment back into America, because as we know very well in Ireland, you can entice investment in, not force it in.
Yeah, and that's a very good point in terms of even the missing roadmap, Mike. And on that note, clearly without that roadmap, if we were to shift gears and be forward focused, I know you don't have a crystal ball, none of us do, but what would you gauge as being next?
Yeah, so it's a very, by the way, big week in markets in the last week. The last 2 days of last week, markets fell 10%. We're into kind of the realm of exceptional market sell-offs and market events. And this one is unusual in that it's a man-made event, not like COVID, not like the global financial crisis. And then we had an emergency or an ad hoc investment committee meeting early on Monday morning. And in our debate, in terms of looking ahead, in terms of investment strategy, we've come up with two very broad scenarios. So the first one is that the status quo as we know it holds, that this is just a negotiating ploy. And over the next couple of weeks, the White House will talk to Europe. They're already talking to Japan, which may help explain the rebound in the Nikkei this morning. And eventually we'll talk with China. So that's sort of the nice soft scenario. In that scenario, we would see markets kind of rebound to their mid-range of the last 6 months. The other scenario is what I call a new status quo, which is really a new world order, a world where America goes from being a benign empire to a very selfish nation state and tries very hard and aggressively to reorder relationships with other countries and former allies and tries to extract benefits from them. The risk with this one is obviously a global economic shock, and also I think of the undercutting of American assets. The dollar has been very strong. American equities are 70% of world portfolios. So that's a more dangerous and more dramatic one. And what we are looking very, very carefully at are the intentions, the maneuvers coming out of the White House in coming weeks, and also the battle for power, because there's there's clearly a number of camps in the White House. Peter Navarro, who's a real trade hawk, seems to have the whip hand, and then other moderates like Scott Bessent, the Treasury Secretary, I think is much more in the negotiating camp. So there's a tug of war going on in the White House, and also just bear in mind corporate America and the big banks are beginning to weigh in now.
Yeah, and clearly there's two very different tracks, in those scenarios that you've mentioned there, Mike. And we've seen, as you said, we've seen heavy sell-offs in the market. Some have likened it to a Black Monday, without being obviously able at this point to predict, and obviously having to wait to see which move the key players make. Where do we stand though in terms of where market sentiment is right now? Are we past the worst, or in the near term is it really kind of put the seatbelt on?
Yeah. So these kind of events uh, condition you to all sorts of time horizons. In our investment committee, we're very quant driven, very number driven.
Mm.
Many of our kind of short-term tactical indicators are very stretched to the downside. What that tells us that we will probably have some form of bounce back within the next 1 or 2 weeks. My advice
Mm.
to clients is not to try and play that, because
Yeah.
you saw yesterday the market did a round trip of 7% within 40 minutes. So still
Yeah.
very violent, very volatile markets. And what we're looking for really is to see if markets can find a base, can find a bottom. We have the earnings season coming up, and I think the reaction of central banks, not just in the States but also in Europe, is going to be crucial. And I think the ECB here have actually got much more room for maneuver than the Fed, because the Fed are dealing with a policy accident by their own government, whereas the other central banks around the world are effectively dealing with the aftershock of that, so they can be
Okay.
more active.
And on that note, how are other countries reacting? Because this is obviously not just a US story. This is international consequences, and we're talking about global response here. So in the context of even Europe, China, etc., what are other countries doing? What actions have they taken so far and potentially might take in the near future?
Yeah, I think what's interesting as an economist watching this is that the idea of game theory, if you like, or
Mm.
people referring to chess or to poker, is
Mm.
back in vogue, and people are trying to second guess the White House, to second guess what's happening within the Trump team, and the roadmap ahead that I'd mentioned. Um, China, I think, is staying is kind of matching fire with fire. They put a
Mm.
34% tariff on American goods. And in a way, this is a sort of a coming of age for them as a world power. And they in a way, they have to stand up to the States. Japan, which is a US ally, is already engaging in negotiations with the US. The US has even put tariffs on Israel. Benjamin
Mm.
Netanyahu was in the White House yesterday. So no
Mm.
one's, apart from Russia, of course, is being spared. Europe is very important to us. There will, I believe, be an Irish delegation in Washington this week. Giorgia Meloni of Italy, who's close to the Trump camp, is in town as well. I think the kind of things I'm looking for from Europe are solidarity across the countries. They've gone pretty light so far. They've opted not to put tariffs on alcohol, dairy products, because they're also sensitive
Mm.
sectors for Europe. The big
Mm.
question is whether they somehow sanction the US tech giants. And there's talk about using the Digital Services Act to take a heavier stance against the likes of Google and Facebook. And what I've heard is that that's probably not going to be the case. They don't want to politicize EU legislation.
Okay, okay. And on that note, speaking of big questions, if we were actually to take a step back and actually come at this from a broader context, would you say that we're at a broader inflection point at the minute? As in, what could this mean for Ireland, for Europe, and that role in shifting global landscape?
Yeah, so I think anyone reading the Sunday View now will know that we have a sense that there is a turning point in the world order. So for the last 30 years, we've had globalization. It's been very kind to Ireland. And I think in the last 2 months, there is every sense that the world order has changed to a kind of a rougher 19th century world order where countries really looking for their self-interest. And I think in that environment, Europe is going to be a very, very strong and significant player. But I think the assumption that we're still in a kind of a globalized world at this stage would be complacent. We don't know what that world order will look like. I think it will take sort of 15, 20 years for it to fully play out. This is effectively the first chapter in what's going to be a big saga.
It certainly is a saga, to be honest, Mike. That's one word for it. If we were to step back and bring this back home to our clients and bring this into the context of what people really should be thinking about in terms of this strategy, navigating this strategy in uncertain times. Could you talk firstly to how our investment committee are responding to this, or are actually positioned in terms of views?
I will. I'll give you a little bit of color because I think the way we approach things is actually quite instructive at the moment. So we have an investment committee meeting once a month. Before that, we have what's called the Global Macro Council, where we try and figure out our sense of the world. And we separate the two because discussing the world order can very, very often distract you from hard investment decisions. And our investment process is very numbers and very fundamentals based. And we've actually made two changes in the last 3 or 4 months, which I think will help the portfolio. So in December, our view is that European equities were at a multi-decade discount. They're much cheaper than US equities, and that the market was maybe complacent, was underestimating this. We sold some of our US equities and put it into Europe. And that meant that we caught the strong rally in European equities at the start of this year. And then in January, in the lead up to Trump taking power, we wrote that American exceptionalism was really strongly priced into markets. You had the big 7 tech companies being dominant, being very, very expensive in terms of their equities. The dollar hadn't been as strong in 40 years. So we felt that the market was already pricing in a really exceptional view of the Trump presidency without the risks. And we actually cut our equity view, our equity rating back and put some money into cash. And we now have that cash ready to deploy when we feel we're getting some clarity.
Okay, thank you, Mike. And that's really good context in terms of how we're positioned in our core active portfolios at the minute for our clients. Mike, we might actually turn to some questions from the audience, if that's okay. I'm just seeing some come in at the minute. So first question, have you heard of von der Leyen talk of 0% for 0% tariffs between the EU and US, and will it materialize?
I think zeros for zero tariffs will actually be quite hard to implement for a whole load of reasons. One, doing that across a whole range of goods is going to be incredibly complex. And one of the reasons the markets have sold off and the White House has delivered its tariff announcement so badly is that it has very light analytical power at this stage. So they've kind of made these big blanket moves. The second thing is that the 0 for 0 tariffs, in a way, doesn't matter that much. What really matters is the extent of the economic shock globally from this move. The third thing that matters, I think, for Europe is the structural changes in the European economy. So I think instead of waiting to see whether we get 10 or 15% tax on European autos, a much more important factor in my view is how European auto manufacturers will deal with the advent of cheap Chinese cars, whether you see some European auto companies become defense companies. So what I'm trying to point out is that there's a whole range of much more structural strategic issues going on under the bonnet that are actually going to be the real drivers of economic and financial returns.
Okay, thank you, Mike. And I'm seeing another question come in here, which is in the context of pharma. So obviously there was concerns initially that pharma would be greatly hit. It seems the initial pass of tariffs has set that aside for a period. What's the views on what might come down the track in the context of the pharmaceutical industry in Ireland?
I think we don't have an official view as
Mm,
such, but the reason it was I think you used the a nice expression, it was set aside, is because I think it's much more of a tax than a tariff issue, and I think
mm,
tariffs on US pharma companies in Ireland or Europe won't resolve much. So I think there's probably a tax discussion or debate to be had there.
yeah,
The position of pharma companies in Ireland is interesting overall because they're heavily, if you think of Pfizer and Cork, heavily embedded in the local economy. They sell into Europe,
absolutely.
and for them to uproot and go back to New Jersey or North Carolina, it just doesn't make sense commercially in terms of either trying to access the
Mm,
European market or the cost benefit, the access to labor, for example, educated labor that you get in Ireland. So there is something of a fallacy, I think, about US FDI that's already in Ireland. I expect a lot of it to stay. The issue, I think, from here is how do you attract new FDI? And this environment makes it much harder to do that.
okay, thank you. I have a more practical question here that's come in from a client. Should I go to cash, sit on the sidelines, and wait to get back in?
I mean, we've already done that to an extent in portfolio. We've not gone wholly to cash. We've gone to a portion of cash. Um, I don't think so. I mean, I think this event has um, already happened. It's sort of, I wouldn't say it's largely yet played out in markets because we will probably bounce and thrash around a bit for a few more weeks. I think if you're fully invested, you can take a you know we you can perhaps take a small bit off, but I wouldn't advise people at this juncture
Yeah,
to go all into
yeah,
cash. No.
I know, and I think it comes
And,
back to
and
that
maybe
age
one
old.
more. So sorry, one more thing. I mean, the vast majority of our portfolios have a decent chunk, in some cases like 60%, of fixed income. And fixed income has actually performed very well. And just looking at the performance numbers, there's a very strong diversification effect coming through across the portfolios.
Absolutely. I think that diversification is key, Mike. And obviously, it goes back to that age old adage of time in the market rather than trying to time
Yeah,
the market.
yeah.
Um, and just maybe one final question. We're nearly at time now. Is there any historical precedence for what we're seeing in the current economic environment, and what lessons have we learned from the past?
There are. Some of them are not too good. I mean, the other period of globalization was between 1870 to about 1912, and then the period after that was very messy in terms of geopolitics, war, crisis, etc.
Yeah,
The structure of institutions today is quite different. They didn't have central banks back then. We do now. Um, and then I think when you look at individual countries, whenever a country ceases to be great, to use that word, the sort of the passage from that, and a recent one is Brexit. You get a lot of market volatility around it.
absolutely, absolutely. Well, I think, Mike, is there anything else you'd want to add before we wrap up for our clients? We're nearly at time now.
The only thing I will add is, we're watching market
Hmm.
and macro and economic developments very, very closely. I think we have a very good investment process. We have a very good framework. We will have more of these calls, possibly one every week, every 2 weeks, as we need. And we're writing on this. We put out a note yesterday, at least once or twice a week now. So we will keep you up to date, not just with what we see happening, but what we're doing as well.
Thank you, Mike. And there's lots to be kept up to date on at this point in time. So I think I'll just take the time now to thank everybody again for joining us. To reiterate again, if you'd like to speak to any of our team directly or your advisor, we're here, we're happy to help. Please stay tuned, stay the course, stay diversified. And as always, thank you for trusting in Unio. Thank you.